Okay, how's it going, everybody? What up, traders? What up, tycoons? Super excited for today's video. We are going to break down ADA real quick. Okay, this is the Cardano token. And I'm going to show you guys a lot of things that you can use to give yourself better entries and better exits on your trades, as well as understand market structure a little bit more and really understand the price and movement and be able to read price action a lot better. Okay, we're going to use a few strategies to do so, and you'll see that once you start to combine strategies, that's what really gives you an edge, and an edge is what you need to be competitive. Okay, you need to have some type of advantage, and by combining signals together, whether those are buy signals or sell signals, whether it's a divergence, a chart pattern, or it's major key levels on the Fibonacci retracements, ultimately, when you can see two or three things aligning together, giving you the same signal, then that will give you much more confidence in your trade and your overall, trading thesis as you navigate the markets. Okay, so make sure to smash the like button and subscribe to the channel if you guys are new. But what we're going to do is go ahead and break everything down. We're going to look at some of the recent price action and dive into the past afterwards, and really, just show you guys what is going on with the chart. The first thing I want to bring to your attention is this trend line on the top and this trend line on the bottom. This is forming a pattern known as a falling wedge or a descending wedge. And this is actually a bullish chart pattern. What you're looking for is you're looking for the price to consolidate in between these trend lines, and then it starts to squeeze. Okay, there's a term known as squeezing, and you'll see the price really start to squeeze in between here. And if the pattern plays out, you'll get a breakout to the upside. Okay. Now, once you combine that with another thing known as bullish divergence, it can help give you a little bit more confidence that, okay, we may be able to get a breakout, or you can use this as a good entry point, right? We're following these trend lines here. We're holding support along those trend lines. And a bullish divergence, if you're not familiar with that term, what you're going to do is you're going to use your relative strength index down here. Okay, so that's what we're looking at down here. This measures the relative strength of a token at its given price. Okay, so meaning if you see the price going lower, right, clearly, all right, Cardano has been going lower, all right, but the relative strength index has actually gone up a couple times at this point, all right. Specifically right here, we have a low and then we have a lower low. And if we look at the relative strength index, we have a low here and then we have a higher low, right? So notice how we're holding this trend line, and as we're pulling back, we're starting to get a bounce off of here. So if we bounce and continue higher, that's going to mean that we're holding the bullish divergence trend line and that we may still see some bullish activity in the future. All right. And if you break this trend line, let's say we bounce up and then come down through, most likely the price action of the token would get bearish, and most likely we would break this trend line down here to the bottom as well. All right. Now, a good example of bullish divergence playing out is actually going to be right here. So notice how we have a low, we have a slightly lower low. Let's just call it basically an equal low. But if we again look at our relative strength index, we have a low here and a higher low here. So you can use this as a signal now, possibly to buy into something, as it's an indicator of possible bullish momentum in the future. Okay, so if we take a look right here, and we'll go ahead and pull out our percentage tool, that was a very nice rally. It ended up going up about 50%. So that was a nice 50% swing trade you could have gotten into. And then once we break this trend line, right? So if we extend this over here to the right, you can see that that's really when there was a sharp drop. Now, another signal on top of the break of this trend line here was also the opposite of the falling wedge. It is a rising wedge. So we're seeing the price action consolidate in between these two trend lines. And once you get a break of this trend line here, you can expect a sharp move to the downside, just like you can expect a sharp move to the upside if we were to break this trend line here. So we're going to be paying close attention over the coming weeks on Cardano and see, are we going to be able to come up and break out past this trend line, right? Or are we going to bounce and get rejected and continue heading back lower, all right? Now, if you're wondering what these three things are right here, these are the Fibonacci retracement levels. You can get them by using this tool right here. I also have a tutorial that's a little bit more in depth on how to use this. So feel free to watch that. Just type in exactly trades Fibonacci. But overall, the three main levels that you want to pay attention to the most are going to be the 61.8 retracement, the 50% retracement, and the 38.2% retracement, right? So what we're doing here is basically measuring if we are going to get a retracement and continuation of the trend, or if we break through these levels here, we could be starting a reversal. And then we will just need to make a high and a higher high to really get the reversal going. But this would be the first step, breaking through these levels versus getting rejected here and continuing the trend, right? Clearly, we're in a downtrend right now. A lot of that has to do with FTX, and a lot of that just has to do with federal interest rate hikes and just the overall crypto winter and bear market that we are in currently, okay? So what we did was we took our swing high, all right, we take the swing high right here, and then we connect it to our swing low down over here, all right, and we're going to see if we come down and then get a move up. Again, nothing moves in a straight line, whether it's up or down. You're going to retrace to either get a continuation of the trend or you're going to break through those levels. So that's really why these are important. The three retracement levels we're looking for, if we do break out past this trend line, is going to be 0.419, 0.452, and 0.486. So just so you can further understand it some more, what we'll do is we'll dive back into the history of the chart and look at things a little bit more, all right? There's a few instances of the retracement levels being very valid, and we'll also go into some new chart patterns that you can also use as well besides those wedges, okay? So if you're following along so far, make sure to smash the like button because, you know, we're really just going to continue with the rest of this content and, you know, it really helps out the channel being a small channel. So the first pattern I want to highlight here is going to be a bear flag. It's the opposite of a bull flag. It's a bullish pattern. And so you're going to notice we have a sharp downtrend. We have a sharp movement to the downside. And then this right here is a little bit of consolidation and absorption. Okay, so we're absorbing that rapid drop. And there's a couple different ways to chart a flag pattern. You know, one of the best, most technical ways is going to be using a channel, right? So basically we're trading in this channel. We're going to get a breakdown and then a retest of the channel and continue, okay? Because again, nothing moves in a straight line. It's going to retrace, right? So we see we come down, we retrace, we continue further, all right? And this is a pattern that you can use besides the Fibonacci tool to really track this, okay? Ultimately, again, once you get the breakdown of this line, in a perfect world, you break below and then you retest the trend line and then you continue heading lower. Now we got a perfect world scenario on this bear flag. Right here, this is a very good example of, you know, using the Fibonacci retracement levels to determine whether we are in a downtrend or whether we are going, you know, to continue the downtrend rather, or whether we are going to break through those retracement levels and try to form a reversal, okay? Because this was a pretty big rally right over here. From those lows to the highs, that was 66%. That was a nice move. And a lot of people get trapped in these moves and end up, unfortunately, buying the top over here, ultimately for us to make new lows. So what we did was we took our swing high, all right, and then we connected it down to this swing low here, right? So we come down, we retrace, and look where we get rejected, right? At our 50% retracement level. That's a key indicator, all right, that, you know, the downtrend is in continuation and that we didn't reverse and head higher. Okay, so you can use this as a selling point to take some profit, right? Or throw some risk management on and protect the trade. And maybe have a stop loss below the 38.2 retracement level. Okay, and really once you combine this with this bearish chart pattern here known as an inverse cup and handle, and what I mean by combining is you're using the information you already gathered that we came up, got rejected, and that we're continuing the downtrend. But you see that we really based out right here, right? It's kind of flatlining right here around this level. That's the base of your cup. And then we have the inverse cup. We get a slight handle. And as soon as we really break that trend line, we get a very sharp move to the downside. That's how the inverse cup and handle pattern is going to play. And then that's also how, you know, just using the knowledge that you've gathered that, okay, we're coming down, we retrace, we're continuing the downtrend. We also have a bearish chart pattern forming. This is a sell signal, whether you want to short something or whether you just want to protect your trade and maybe get out and look to reinvest later at a further point in time at a cheaper price, okay? So we'll go over here and we'll just show some more examples of all of this happening. So here's a really good example of a retracement reversal. Okay, so most of the examples we've shown here so far have been of a retracement working and continuing the downtrend. So if we take these lows to these highs, we're going to look to see if we come up, retrace, and continue the uptrend, right? Well, in this example, we can see that actually we don't. We really consolidate in this period for a very long time. And ultimately, we break the retracement levels and start a downtrend. We start a reversal. So we came up, we didn't retrace. And then look, we end up creating lower lows and heading down lower after, we went through these bearish patterns that we already covered. Okay. Now, something else that you can use is the opposite of a bullish divergence. Again, we're going to take a look at our relative strength index here, and we're seeing that the token is going up in price. So naturally, the strength of the token should be rising as well. Well, in this case, we have a high and we have a lower high. We have a high here and we have a higher high here. So when you are making higher highs on the token price, but making lower highs on the relative strength index, that's a bearish divergence. It's an indicator that you may see a large drop or a small drop in the future, okay? And if we take a look at that move, it went down 40%, it went down 42%, went down 60%. I mean, that was really, a big indicator that we were going to have some bearish activity. You combine that with the fact that we did not hold our retracement levels, right? Again, we're combining signals. So we're using this original bearish divergence signal, okay? And we're seeing that, okay, well, that most likely we're going to have a drop. We get around a 40% drop. We really consolidate and then we break through. So now we know that we already had the bearish divergence. We combine that with the break of the retracement levels, and it's just a good indicator that we're going to have some more bearish activity in the future, all right? Now, the next pattern that we'll look at, okay, is going to be a continuation pattern. And it's going to be this pattern right here. It's going to be this nice triangle pattern. So it's not a wedge. It's got a very clear defined base support level. And then we have this trend line here to the top. This pattern can be bearish or bullish, but most of the times it's a continuation pattern. So what that means is that you're going to look at what price has previously done in the past, and most of the time it's going to continue that trend. Okay, so we see we are in an uptrend here and we form our triangle pattern, and ultimately we break this trend line here to the top and get the continuation of the trend. All right, so that's what a continuation pattern basically looks like. Over here, we had another sell signal, okay? And this, again, was a bearish divergence. So we're noticing that we have a high here. We have a higher high here. The token is rising in price. The relative strength of the token should be rising as it's getting higher. It should be getting stronger. We're seeing the opposite. We're seeing a high and a lower high. The relative strength is falling. It's an indicator of future bearish activity possibly. And, there's about a 50% drop right here, okay? Yeah, roughly 60% drop from those highs at the moment that the bearish divergence was spotted, okay? And if we go into the past a little bit more, what we're going to do is we're going to look at some more valid, retracement level examples. And this is, another way to draw a flag pattern, okay? And it makes it look much more like a flag. In this case, it's going to be a bull flag instead of a bear flag. So, you have your flag pole right here to the upside. You have your trend lines right here. You can connect those. And ultimately, again, once you break that channel, once you break this trend line up here to the upside, you're going to get a nice impulsive move, in whichever pattern the flag is, right? Whether it's a bull flag or a bear flag. In this case, it's a bull flag. We get a strong breakout and really explode on the price. Okay. Right here is a great example, again, of, the continuation of a trend, right? So what we're looking at originally right here is, we're looking at our swing low up here to our swing high. We have this very sharp move to the upside. We come down, we retrace, and then we push higher, right? We hold the 50% retracement level very well right in through here. And then ultimately we end up forming that bull flag and having a breakout of the bull flag. Now over here is an example of, just the trend breaking, right? So what we're doing over here is we're looking and we're taking our swing highs, all right, connecting them down to the swing lows. And we're going to see, are we going to retrace and continue the trend? Or are we going to break through these and start a reversal? Well, we end up getting a reversal. We break through these levels right over here. Okay, you can see that. And then what we do is we make a high and a higher high. So instead of making highs, lower highs right here, we end up doing the reversal, make a high and a higher high. Higher highs, lower lows, higher lows, lower highs. These are all some simple terms that you should really get yourself familiarized with. They're going to help out a lot. Now over here, we have another example of how you can combine signals to really give yourself a stronger thesis. What we get is a bearish divergence combined with the bearish chart pattern known as head and shoulders. So we have our left shoulder, we have our head, we have our right shoulder over here. And in the beginning of this, we get a bearish divergence where we're making higher highs. And then on our relative strength index, we're making lower highs going down. So the token price is getting weaker as it's forming this bearish chart pattern, and it's a good indicator that some bearish activity could be coming in the future, and we end up getting an over 50% drop. Now over here, again, we have our bull flag, we have a sharp move to the upside, we have our trend lines right here, we break through, we get the sharp move up, and then form that bearish divergence, form the bearish chart pattern, and get a very strong pullback, right? Over here is just another example of a trend continuation using the fibs, all right? So we're connecting swing highs right here down to the swing lows. We come down, we retrace up to these levels, and then we continue the trend and make a lower low, right? Again, getting rejected right around the 50% retracement level, ultimately to cause a move down. Now, this is where a lot of people get trapped, right? They're getting trapped because they're catching this massive move. It's 130%. What happens is people get FOMO, okay? So, you have the people who buy in down here, you have the people who buy in up here, and, a lot of times they're okay with taking profit on these trades, whether it was they were able to capture the whole 100%, whether they captured 20% or 50% of that. There's a lot of people taking profit at those levels. And really, we're seeing that, you get trapped, right? There's a lot of people who get trapped right here, and then they're forced to sell, and it drives the price down very quickly. And, you really could have spotted that, all right, hey, maybe these aren't the levels that I want to be buying at, because these are our retracement levels. And if we get rejected at these levels and head down, get rejected down here, most likely we're going to continue the trend and end up making a lower low, right? So this is something that you can really use to your advantage to help prevent you from, FOMOing into really big movements and potentially spotting whether that was just a fake out just to ultimately drop even more, right? Because after we got rejected at our retracement levels, we come down and that was over a 75% drop. That's huge. I mean, imagine putting $10,000 into it and it drops 75%. You don't have any form of, risk management. You don't have any way to protect the trade. You're down to 2,500 bucks. That's devastating for some people. Over here, what we're seeing is first, originally, we're seeing a trend continuation. All right. And then we notice after the trend continuation, we get a bearish signal. Okay. So we're coming up, we're retracing to our 3 retracement levels right here, and we push higher. But after we push higher, we make a higher high, right? Going up, the relative strength index is going down. So the relative strength of this token got weaker after we had a trend continuation, showing that, maybe the trend is coming to an end, or possibly we could be getting a pullback before pushing higher. And again, just another sharp move to the downside, right? Ended up dropping 50%, 60%. It goes down even lower to like 70% plus, okay? Ultimately off of that bearish divergence sell signal, right? Now, we've been showing a lot of bearish divergence. Here's a great example of some bullish divergence where we're making lower lows and then higher lows on the relative strength index. So we have a low, lower low, we have a low, higher low right here. The relative strength is increasing as the token is getting cheaper in price, and ultimately it leads to a very nice move to the upside. We won't measure the whole thing all the way up to there. You see that's over 200% plus, but just initially from the initial lows to highs was 100% trade. And then, if you would have held on to that, right? And the reason you would have held on to that is because we're holding retracement levels. Okay, see that? Boom, right here. And what we do is we wick down below, but we don't really close below, and we're holding these levels. So a big difference between holding something and a fake out, right, is going to be, new candles opening and closing below, right? So we come up, we come down, we very shortly trade down here at these levels, and we really just hold them ultimately and really trigger some stop losses. There's something called liquidity hunting, and algorithms are very good at this, as well as market makers. Algos are very present in the market. Whether you believe it or not, about 70% of trading is done by algos. And so what they're doing is they're drawing liquidity, AKA they want to buy in. All right, they want to buy in at these prices. So what they do is they have some sell orders to push the price lower, and everybody with a stop loss below 61.8 retracement level is getting sold out. So boom, 1 day people are getting sold out, 2 days people are getting sold out, 3, 4, 5, 6 days people are getting sold out, and they hunted all of that liquidity right there because they were ready to push the price higher and continue the overall uptrend, right? If we would have broken these levels, came up, retested, and pushed down lower, that's a much clearer signal that we broke the retracement levels and are heading for a reversal, right? So yeah, that's the bearish divergence right there. And then we can come over here and we're seeing some more bear flag patterns. The bear flags are one of the easier patterns to spot in the market, especially for beginners. We're getting the, sharp move to the downside. We're getting the absorption channel right here. We break, notice how again, we break below, retest the channel, continue heading lower, all right? Over here, we're seeing the same thing. We actually have a rising wedge, which is a bearish pattern that leads us into the bear flag. So here's our rising wedge, and we're trading in between these two trend lines here. We break this level, we come down, we retest, we get a sharp move to the downside. This sharp move to the downside begins our pull for our flag. Here's the flag itself, that nice channel. Okay, we break the trend line, and boom, we get a sharp move to the downside. Right before there, what we had was a inverse cup and handle, one of the patterns that we looked at in the beginning. Okay, and we're seeing that, we basically have this base level right here. All right, we have a rounded top, we come down, we bounce a little bit, and then as soon as we break this level right here, we get the sharp move to the downside, and that really starts, the whole, series of bearish patterns. So hopefully you learned something new in this video. Hopefully you learned something about how, using technical analysis can give yourself a few entry and exit signals. Again, none of these are going to be 100% and work 100% of the time, but once you are able to, get familiar with these signals, combine them together and see, maybe 2 or 3 signals, basically, again, combined together, right? That's going to give you a much better edge and really help your trading journey and experience out. So if you found anything useful in this video, make sure to smash the like button, subscribe to the channel, because I'm dropping content like this every single week. I'm doing about 5 to 15 videos a week. It just depends on how busy I am. And I also do viewer requests every single week. So if you liked this breakdown of Cardano, ticker symbol ADA, make sure to drop your ticker down below in the comment section, and I'll be happy to analyze it for you and upload a video on it as soon as I can.